The dreaded D word has haunted us since crisis hit in 2008. For all our economic sophistication, deflation is a paradigm that still befuddles policymakers. The elusiveness of remedies has by default made the eluding of its onset the only true remedy. With the exception of Japan, so far so good. But we're not yet ready to read the last rites on the scare. Or are we? How are prices behaving these days? Are they low, slow, or on the go? Rewind to the 1970s, and inflation was the big enemy. The big intellectual guns were aimed at understanding the phenomenon and wresting it to the ground. Monetary tightening at the end of the decade seemed to do the trick, but the 1980s saw a price revival that needed another stiff dose of monetary medicine to rein things in. Since then, expectations that were anchored at stated target levels have kept price growth remarkably in line. The outcome? There's a very well-defined playbook on inflation. Deflation is another matter. Japan's battle with the beast is going on a quarter century with no real breakthrough in sight. In the final analysis, history may conclude that quantitative easing rescued the US and Europe from Japan's fate, but it's likely too early to tell, unless there's something current prices are saying. Cursory analysis of recent price activity can actually be shocking. For 5 months, US consumer prices have been flat on a year-over-year basis. Get it? That's zero growth, on the borderline of deflation. Europe is little better. Euro area consumer prices dipped below the zero line last December and only just popped into positive territory, marginally, in May. Tax changes helped to push Japanese prices to higher growth than seen in over 2 decades, but that is fading. Most recent data has slumped back into zero-hugging territory. So, is that it? Are we all joining Japan in a deflationary or disinflationary funk? Not so fast. Recall, we have seen commodity prices tumble over the past year, and those effects are spilling into retail pricing. Now, as we have argued many times already, commodity price plunges are more about growth than about economic weakness, so their effect this time around should be discounted. Moreover, central banks aren't supposed to pay as much attention to specific commodity price movements as to movements in the general price level. As such, what's more important is the movement of so-called core prices, the ones that net out the effects of food, energy, and other volatile price categories. How are core prices doing? Here, year-to-year prices in the US are actually rising at a modest but decent 1.7% year-on-year, with monthly gains punching well above the 2% level since January. Continue the recent pace, and the Fed will have more traditional worries. Year-to-year core prices in Europe are still soft, but are moving toward the 1% mark. This is primarily the result of monthly increases, which have been gaining pace since March. Things are somewhat different in the UK. There, year-to-year prices are rising, but core prices are trending lower. Japan's core price growth is very slow, hugging the zero line closely since last August. Unfortunately, Japan remains bound in structural issues that are still in search of a lasting remedy. Well, this might seem like a mixed story, but what seems to emerge is that the engine economies, the US and Europe as a whole, are seeing the early signs of prices rising on a monthly basis to target levels. It's not long enough or strong enough to pull the numbers that the media uses up to levels that would capture the public imagination. But if sustained, they ultimately will. What will sustain these increases is basic demand in the economy, and that's where the story brightens. Data show, and many agree, that there is growing evidence of pent-up demand, which in simple terms is sort of an anti-excess. It's obvious in the US housing market, and based Pre- and post-crisis activity levels seems obvious in Europe as well. Moreover, the investment hibernation that has been in place since the crisis has pushed industrial capacity usage to pre-crisis heights. And if demand is about to take off, there's going to be a lot of instant investment happening. The bottom line? Prices seem to be on the move. If so, it would be some of the best evidence of economic liftoff. And unlike deflation, we know how to tame the other beast if it rouses. Until next week, I'm Peter Hall.